Right, so global uncertainty, worries about the global economy have been driving record gold prices, but in some cases weighing on demand for industrial metals. Let's get more from Ben McMillan, Chief Investment Officer at IDX Advisors. Ben, great to see you as ever. Thanks for joining us.
Thanks for having me.
Is the bull case for gold still intact?
It is. I mean, amazingly. Now, that's not to say that we couldn't see some, a pause in the near term. It's had a spectacular run. But I mean, I remember having this conversation with you last year, and I was saying, people thought the gold run was over. And I always tell investors, we're seeing something different. This is a flight to safety. This is gold now competing versus the dollar as the new kind of reserve currency. And so, we're no longer seeing a shift along the demand curve. We're seeing a shift of the demand curve. And that's driven in large part by central bank buying, which doesn't show any signs of slowing down.
Do you think we've really reached that stage where America's status as global reserve currency has been damaged?
I mean, it's a very good question. To lose, global currency reserve status takes decades, but we are certainly in the early phases of that. And I think we go all the way back to the beginning of the Russia-Ukraine war when the U.S. seized dollar-denominated assets of Russian oligarchs. And that sent rung alarm bells for a lot of folks. Value judgments aside, other nations saw that could happen and quickly started having conversations about should we be, denominating oil transactions and things like gold. The IMF has talked about special drawing rights, basically a global currency backed by gold. So it's more than just academic theory now. Countries are starting to move away from that. That doesn't mean it's going to happen in a year or two or three, but that's a train that's tough to turn around once it's left the station.
That's interesting. Yeah, I mean, whatever. It was a brutal, horrible invasion of Ukraine, seizing those dollar assets. Obviously the right thing morally, but America may have shot itself in the foot economically there.
Yeah, and it was interesting because people said, all right, this is the, by and large, everybody kind of agreed this was the right thing to do. But again, there was a lot of other nations, even allies, all of a sudden talking about, wait a second, does this mean that the U.S. could do this to us if the wrong type of administration came in, if we didn't play ball, as it relates to, tariffs or trade? And now all of a sudden we're seeing, there's no talk about seizing assets, of course, but, the tariff discussions, have really ignited tense conversations, particularly between the U.S. and China. And so I guarantee, China has been the biggest seller of treasuries, swapping that for gold. And they've been the ones that have been spearheading discussions with other nations about denominating, oil transactions in gold. So again, there's a very robust kind of, tailwind pushing gold as a substitute for the dollar. That doesn't mean it's going to be an easy transaction. Doesn't mean it's going to happen quickly, but the forces are out there kind of pushing in that direction.
Yeah, we were joined earlier by Stephen Roach, a famous economist in the States, and he said that is an option for China, dumping U.S. treasuries. And of course, that could cast a cloud over the U.S. dollar if they were to do that.
And I think we're seeing that. I think, the so-called bond vigilantes have made their voices known. And part of that, look, the U.S. has a huge amount of treasuries that has to refinance this year. That's no surprise. China is one of the largest holders. It's no surprise that they've been, divesting treasuries in recent years, stockpiling gold, among other things. But again, that is a weapon that they have that we cannot ignore, because frankly, the U.S. is in a position now where higher interest rates really cause a lot of asymmetric harm here in the States, not just for the consumer, but for the government at large.
Sorry, what do you mean asymmetric harm?
Well, at this point, you look at they call it the 10-year yield, right? And that's why Powell and everybody's focused on the 10-year. Every 10 basis points, north of 4%, every 10, 20 basis points higher that yield goes, the cost of our debt, just the cost of our debt, occupies a higher and higher portion of GDP. So it's, the analogy I just gave somebody earlier this morning was, America is basically a country where the credit card is maxed out. And when you've got a 0%, balance transfer or 1 or 2%, that's not a big deal. But, the move from 10% to 11% hurts a lot more on that interest rate than it does from going from 0 to 1%. Now, the flip side, of course, which I will also say is America does have a powerful growth engine. And so there's kind of two ways when you've maxed out your credit card. You either reduce standard of living and, take the austerity route, or you increase income. So I'm cautiously optimistic that America can potentially thread the needle there. But again, it's, China in no small part can actually, to some degree, control the interest rate, or at least influence the interest rate that we pay in our debt. And that's absolutely something that that they know they have.
What about copper? I know the market's been distorted by copper hoarding in the United States to evade tariffs, but would you be bullish on copper, even though there's a cloud over the world economy?
Yeah, so copper's kind of the classic, and this is why they call it, Dr. Copper. It's, I learned that term, first year of grad school in economics, because it's kind of offers the most interesting, robust insights on the global economy. And so the near term, it's a tug of war between kind of near term recession concerns, not just in the U.S. but globally. You look at like China, for example, their property sector, I think, accounts for something like 30% of all copper demand. So, that's weighing on copper prices in the near term. Of course, last time we talked, the big secular bull case for copper is this green energy transition, which isn't just electronic vehicles, but it's also now AI. It's the electrification of these grids and powering these data centers. But so when I think about that, when I think about copper, we've seen a lot of volatility just in the last 2 weeks. I think we saw copper top out at like, a little over $5, per pound. Now it went down, shed $1 within weeks on tariff concerns. I think it's going to be range bound this year. But I think when you start looking into 2026, 7, 8, that's where, you could really start to justify, $6, $7, $8 a pound for copper.
We'd better jump. Ben, thank you very much and have a great weekend.
Thank you.
Ben